HDFC is in focus. They have raised funds via an NCD issue, almost close to 5,000 crores is what the company has raised on last Thursday. The management now joins us to explain further detail. Mr. Keki Mistry, Vice Chairman and CEO at HDFC Limited, is now with us. Good morning, sir. Thank you so much for taking out time for us. Firstly, if you could just explain us what is this issue about, what is this instrument NCD, how much cash flow comes in, and over the period of next 3 years, how much cash flow is likely to come into HDFC?
So let me talk about the issue. We have come out with an NCD cum warrant issue. The way it works is that we have raised a total of 5,000 crores of rupees through the non-convertible debenture issue, and along with each debenture there are warrants that have been given, and each warrant holder can come to us anytime in the course of the next 3 years, pay us 1,475 rupees and buy one share of HDFC. And this 1,475 rupees is in addition to the 14 rupees that have already been paid on the face value of the warrant. So currently what we have received is only the NCD money, which is 5,000 crores, and the face value of the warrant, which aggregates to about 51 odd crores. The increase in capital will only come over the next 3 years. And if all the warrants get converted into equity, then it will result in a total receipt of about 5,380 odd crores rupees.
So can you just clarify that amount? 5,000 crores will be added to the net worth over the next 3 years.
More than that, 5,300 crores. 5,380 odd crores. That is the maximum amount that can be received on conversion of all the warrants into equity, assuming every warrant holder comes to us, pays us 1,475 rupees a share and buys one share of HDFC at that point of time.
So as you said that as of now or in the immediate basis, the cash flow is not particularly that great because of this issue, because they are only paying about 14 rupees. What is the capital situation now? Will it support growth for the next 3 years?
We have sufficient capital at this point of time. So the beauty of this structure, or the reason we went for this structure, is because it gives us money through debt now at a low rate. The debt is actually coming in at a cost of around 1.43 odd percent. But and it also gives us a window to get capital over the next 3 years. And over the next 3 years, it is possible that by that time we may look to raise capital. So this gives us that window. The maximum dilution that can happen if all the warrants get converted into shares will be 2.2%. So it gives us cheaper debt now, with the possibility or with the likelihood of getting equity over the next 3 years at a premium of close to 25% over the SEBI floor price. The SEBI floor price for this issue was 1,189 odd rupees, and the warrants will get converted into shares at 1,475 rupees, plus there is a 14 rupees that has been paid per warrant. So if you calculate that, the premium would amount to about a little over 25% over the SEBI floor price.
So is this a first of a kind of its product? You expect further issues or further payers to follow with such NCD issues because of the benefits that you just said of such a largely such an issue in terms of cost of funding?
My sense is this is the first of its kind in India. We had come out with an NCD cum warrant issue in 2009, but that time the structure was a little different, because at that time the entire warrant price was taken upfront. Now what we've done is we've taken a lower warrant price. The warrant price is only 14 rupees payable upfront, but the other value of the warrant is being used to discount the rate at which we will borrow money, and therefore the interest cost on the debenture will be only 1.43 odd percent. So in that sense, yes, it is a first of its kind.
So between now to when we spoke earlier, RBI has cut rates by about 50 basis points, overall by about 125 basis points. What's the impact do you think it will have on growth in the coming quarters?
My sense is that the investment cycle it's only a matter of time before the investment cycle takes off. My sense is that if you were to look at a macro perspective for India, India has never been is in as good a spot, in as good a position as it is at this point of time. A report card of India today looks very, very good. Inflation numbers have come down significantly, and inflation has come down on a fairly sustained basis. So it's not sort of one-offs which have caused inflation to come down. Secondly, the fiscal deficit has come down over time. The current account deficit has come down significantly. The rupee has, even though the rupee did see some depreciation because of the global issues, it is still probably one of the best performing currencies in the world. RBI has built up sufficient reserves to take care of any currency volatility. So all in all, it's been a great report card for India. And my sense is that it's only a matter of time before we start seeing a pickup in the investment cycle. And as the investment cycle takes off, and it may probably start with a little more of government investment followed by private sector investment, those investments will result in a lot of jobs getting created. Jobs will lead to income, income will lead to more consumption, and as consumption increases, companies which today have excess capacity will start using up those excess capacities and will look to start making investments again. So one
picking up, is it only because of the capex utilization that you explained?
No, my sense is that some of this is because of excess capacities that they are carrying, but that excess capacity will get utilized, as I was explaining a minute ago, as more investments. First, it starts with government investment. Along with government investment, private sector investment would also happen. And the sector that needs the most amount of money is infrastructure. And as the government and the private sector start investing, jobs get generated, jobs get created, jobs lead to income, income leads to more consumption, and as consumption increases, companies with these excess capacities start using up those capacities and they look to start investing.
So REITs listing is something which has been spoken about. A lot of companies that we are talking to are looking at that instrument. Will it be a game changer for the real estate space? How would it work?
I say that because if you look at REITs, for example, in Singapore REITs have been an extremely successful product. And if you were to have REITs, today if you look at a common man can invest in equities, a common man can invest in debt instruments, he can invest in mutual funds, but he cannot invest in the real estate. And if you were to have a REIT product, then it enables even a common man with limited capital at his disposal to be able to participate in India's real estate story. That's number one. But number two, more importantly, it gives property owners and more so developers the ability to convert their assets, their commercial properties, which are today fairly illiquid, into liquid instruments of REITs. So therefore, REITs would, in my view, be a game changer over a period of time. But we need to get that initial thrust going. We need to get the initial investments going. And my sense is over the next 3 to 5 years, REITs will become an important instrument to invest in the Indian markets.
So just focusing in on the real estate demand, a lot of reports, a lot of surveys indicate that there has been a significant slowdown in the real estate deals that are happening or real estate demand overall. What is the sense that you're getting?
See, I cannot comment on anything post 30th June. So any comment I make is for any period prior to 30th June. The reason obviously being that we are today in a closed period and our results will come at the end of the month. We can talk about the current quarter only after results. But giving you a more macro view on the Indian real estate sector, the structural demand for housing in India is always going to remain strong. The reason is that India has a very young population. 60% of India's population is below 30 years of age. And the first time, or what our experience shows, that the first time an individual buys his first property is when he's between 35 and 38 years of age. So people buy their home only when they are in the mid-30s. And with 60% of the population being below 30 years of age, all these people will structurally, over the next 3, 5, 7, 10 years, need housing, and therefore over a period of time also housing loans. So if you take a medium to long term view, there is a structural demand for housing which is always going to keep coming up. The important thing is to make housing more affordable, and therefore if you look at the growth that is happening or that has been seen in India, the growth has largely been coming from the outskirts of big cities and from tier 2, tier 3, tier 4 towns. It's the heart of big cities where property prices are high, where the growth numbers have generally been weak.
So thank you so much for joining us and explaining about the NCD issue as well as what do you make of the current macro situation of India. That was a view coming in from HDFC. On that note, we're taking a quick break, coming back in